Hello everyone, welcome to the Barakah Finserve Podcast series. Through this platform, we aim to bring simple yet effective and thoughtful perspectives on markets and investments from some of the best minds in the financial world. Insights that cut through noise and focus on long-term wealth creation. These times, markets are full of headlines, volatility, and strong opinions. In times like these, clarity and perspectives matter more than ever. It gives me a lot of pleasure to welcome Mr. Manish Sonthalia, Director and Chief Investment Officer at Emkay Investment Managers. Manish brings with him over 3 decades of rich experience in equity fund management and research, having navigated over multiple market cycles with a disciplined and long-term approach. Manish, thank you for joining us. It's great to have you here.
Thank you for having me.
So, Manish, so I would like to start with the macro headlines and long-term perspective. Investors today are constantly bombarded with headlines, be it global trade or geopolitical developments, budget, monetary policy, currency, and commodity price fluctuations. Having seen multiple market cycles, how should investors filter this noise, decide what truly matters over the long term?
So, my 3 decades of experience tells me that bad news gets priced in immediately and good news gets priced in only very slowly. And that is the truth, that whenever there is negativity, etc., you have a whole knee-jerk reaction to the market on the downside, etc. But coming back to the macros, things are pretty fine as far as India is concerned. India is in a Goldilocks scenario as far as Indian macros are concerned. Very low inflation, very low interest rate, 7% or thereabouts your real GDP growth, right? You have a very high liquidity, 125 basis point repo rate cut that has happened over a period of 1 year. And, domestic facing economy, self-reliant in terms of your consumption, etc. Now, with the trade deal also getting announced, you have announced the UK trade deal, you have announced the Europe trade deal, US trade deal. I think things couldn't have been better for India.
Okay.
Having said that, I think geopolitical issues are clearly one thing which needs to be kept in mind, and it's very, very unpredictable.
Okay.
And the US, the debt situation, etc. These are some things which need to keep in mind. But having said that, I think it all boils down to numbers in terms of earnings, etc. And as far as the global macros and local macros which you keep at the back of your mind, things are not bad at all. Things are in fact very good for India.
That's interesting. So the real takeaway here is separating the short-term narratives from long-term fundamentals and staying anchored to the process rather than the headlines.
Yeah. See, today we are in an AI world, information bombardment world, which the world will do everything to throw you out of your position. You have 7 or 8 media channels which keeps on breaking news every minute. Every minute is a breaking news.
Absolutely.
So, all your good stocks, some or the other channel will ensure that you sell those. Keep on buying and selling, Ultimately, you enrich only the broker and it does not end in wealth creation for yourself. So if you want to have peace and you want to create wealth, please understand one thing: investing is a very boring process. If you are seeking excitement and kick, you better go to Macau or Kathmandu to play casino. Stock market is not the place where you can get kick as well as wealth creation.
Absolutely.
You have to be alone. You have to be thinking all the time about your product. And this will not happen if you shut out the noise which is there. And noise is basically full of junk. There is very little difference between data and information. A lot of data, very little information. What is required is information, not data. And everybody is throwing a lot of data. You have Twitters of the world and the social medias and the media channels. It results in a lot of clutter in the mind. There has to be clarity of mind if you want to have wealth creation. So that is when you should seek to differentiate between what you want to hear and understand and what you don't want to hear and understand. That is something which you have to do it yourself. Introspection will only happen yourself.
I think absolutely, Manish. I think that's a very good piece of advice. You rightly said investment is a very boring subject, because when we do a lot of these investor awareness programs, I mean, we keep repeating the same presentation. because fundamentals and those concepts never change.
Absolutely.
And-
Nothing has changed in the world of investing in the last 100 years
Absolutely.
and next 100 years.
Absolutely.
Only the temperament changes, the situation changes, these things change. But principles of investing have not changed.
Completely agree, Manish. Talking about valuations, Manish, with valuations appearing stretched in some parts of the market and relatively ignored in others, how do you read the current Q3 earnings season across large, mid, and small? And just a follow-up on that, which sectors look promising in terms of growth potential?
So earnings, I think, would be better than what was assumed to be for the third quarter. The expectations were really low. And I think on those low expectations, the outcome has been better than what was expected. So we are looking at high single-digit earnings growth for large caps. We are looking at 15-16% sort of an earnings growth for the mid cap so far, but there's still 5 more days for the earnings season to play out. And even the small cap space, we are looking at 20% earnings growth. In this backdrop, the valuation correction that has happened over the last 1.5 years has brought down valuations to very palatable levels.
Okay.
There is nobody in the market who can say that today valuations are very, very excessive. Yes, there are pockets where they are excessive. There is overvaluation and there is over ownership. You will do well to stay away from those places. So I think 3 things have happened. One is your earnings growth. The other is your valuation, overvaluation or undervaluation. And the third is over ownership or under ownership. Last 5 years, lot of retail money, PMS, AIF, mutual fund, SIP flows have gone into concentrated sectors and stocks, resulting in over ownership. We are very certain about the earnings growth part. Valuation correction has happened with the market over the last 1.5 years. What do you do with the over ownership, under ownership? Here, people who are stuck are just waiting to sell. Don't get into those spaces.
Okay.
Roads, railways, defense, renewables, EMS, etc. Very elevated valuations, very, over-owned stock. There you will do well to stay away from.
Okay.
Under-owned spaces, which sectors like consumption, rate sensitives, IT, pharma, these are some of the spaces where there is going to be sector rotation.
And Manish, from a long-term perspective, which sectors you think need incremental or additional capital to flow in or to be allocated and to build capabilities, in those sectors?
So I think you have to be ahead of the curve. And I think in today's context, the entire globe is investing in AI capabilities.
Okay.
You find niche areas in AI capabilities and the ecosystem which will be required for creation of the AI ecosystem. That will be basically much in demand. So what we used to think of as commoditized sectors are going to be in high demand for the creation of the AI ecosystem. I'm referring to data centers. I'm referring to the HVAC, the networking capabilities, the cabling capability, the air conditioners, the real estate which is going to be required for the data centers, etc. These are the critical minerals today, the coppers and aluminiums and tungstens of the world and galliums of the world. We are in a different world altogether. Each country is to himself. We are not in a networked world these days. Bilateralism is the norm. Multilateralism is dead. We need to secure our future ourselves. And that is why these are critical minerals which are in short supply. Apart from the regular themes of consumption, savings and investment, you need to see where the global pools of capital are moving.
Okay.
Where there can be a re-rating of valuations, which is today not clearly factored in by the market. These are some of the areas.
Interesting times indeed, Manish. So that gives investors a useful framework to think how earnings quality and valuations go together rather than looking at either in isolation. Talking about the last 1.5 year, Manish, I mean, equity market returns have been relatively muted despite earnings growth in some parts of the market. So what has contributed to this phase for the equity markets, and how should long-term investors think about the road ahead from here?
See, returns in India came very front-ended post-COVID. From 2021 till 2024, we got some very outsized returns. This was on the back of very significant high earnings growth of corporate India. Now, on a very high base of 2024, you had a 2025 where earnings growth was only 5%.
Okay.
And valuation, because the returns came very front-ended, a lot of flows that came into India post-COVID, both FII flows and your DI flows in any case were happening. Stock elevation in terms of prices happened much too quickly. And that is why prices went through a consolidation.
Okay.
First of all, the earnings was very muted on a very high base. It was a base effect.
Okay.
Because 2021 to 24, you had very high earnings growth. The base was set very high.
Okay.
On that very high base, 2025 over 24 came in at just 5%, and you had very elevated valuation. That is why we saw this correct. And this continued into FY26, where 5% will give way to 10%. So I think the normalization of time correction, price correction, is a self-adjusting mechanism. And if the returns would not have been so sharp between the periods 2021 to 24,
yes,
you should broadly be having a markets which was going up in the last 18 months. But markets rarely follow what we expect the markets to do. They have to do what they have to do. So basically, that is the main reason where front-ended returns gave way to time consolidation, price consolidation. Now we are moving with the second round of growth on the higher side. So nothing to worry about. Indian markets on Nifty 50 basis or the benchmark basis will literally double your capital in 6 years. 12% sort of a returns is doable. That still stays the course.
So may not be in a linear fashion.
Yes, markets,
yes,
stocks never give you returns in a linear fashion. This is the difference between a bond market and a stock market. In a bond market, you expect 1 paisa every day. It is a linear on the upside. But in a stock market, it is up, down, but there the returns will be 12%.
Absolutely.
So this is the nature of the beast, the nature of the stock market, and it will not change.
Absolutely. So you have to make sure that you are in the market.
You have that gumption, you have that stomach to withstand the volatility. And as they say, no gain without pain.
Yes.
If there is gain without pain, then it is a bond market.
Absolutely.
So that is the difference.
Absolutely. Cannot agree more than that. So that puts this phase into perspective. So it's less about something being fundamentally broken, but it's more about markets working through valuations, cycles, and a period of consolidation, as you rightly said, rather than continuous price appreciation in a linear manner. So we should be talking about gold and silver at this time. So gold and silver has seen such a strong rally during this period of global uncertainty. So how much of this move is driven by fundamental factors and how much by euphoria or the sentiment?
No, it is not euphoria. I really don't believe that everything is speculation in the precious metals. As I said, that the world is changing. You have a new technology before us, which is the AI-driven world. And critical minerals are going to be required in the AI ecosystem for data centers, for renewables, for electric batteries, for semiconductors. These critical minerals, which are industrial metals like your silver, like your gold, like your copper, your aluminium, gallium, these are going to be very much required over the next 5, 10, 15, 20 years. Apart from that, there is a de-dollarization trade which is happening. Excessive borrowings in the US, recurring trade deficits in the US, loss of trust in the US dollar. These are some of the reasons why you should have some element of gold and silver in your portfolio. I would say not 50-60%, but at least 10 to 15% should be there in your portfolio at all given points in time. Yes, there will be volatility in the short term, but everything is not speculation. After the prices have settled down, these minerals will be, or these commodities, metals, etc., will be in short supply. The direction on all these things are really on the upside in the long term. Don't assume a $117 stock price, silver price to come down to $20 anytime soon. Because these are industrial metals, you require silver in semiconductors, electric batteries, photovoltaic cells. Where will you get it? There's not too much of production on a global basis, on a annualized, on a 1 year basis. You don't have unlimited product. These are scarce, but these are very much required. Unless and until you find a substitute, which again will happen someday, but today you don't have it.
You don't have that. Yes.
So that is where they should have a place in your portfolio. Everything is not speculation in gold and silver.
So that makes a very strong case for holding these precious metals. So it's also about balance and diversification rather than chasing short-term performance. Talking about risk and asset allocation and even international exposure. So given the volatility across asset classes, should investors think about risk management and what should be the overall portfolio construction like today? And should international investments be a part of the portfolio?
You can, through the limited options that you have through LRMS, you can look to deploy globally. But I would believe you should have 10 to 15% in precious metals. You should have 10 to 15% in your cash or bond holdings, and the balance you should be in equities. That is broadly how you should have. And within equities, you distribute between international and And that is how you have a basic hedge against all the asset classes.
Absolutely.
That is how you should do it. If you want to diversify even more, then you could buy land as opposed to constructed real estate.
Okay.
Land is a ongoing appreciating asset class. Real estate, developed real estate may or may not. So you should have a place for your own living. But if you want real estate as an option, that you should consider land. Not flats or buildings or anything like that.
So because is flat a depreciating asset?
No, because these are basically demand and supply equations. Too much high prices attracts a lot of supply. I believe that there is urbanization that will happen, but these are very long cycles. We are coming out of a very strong real estate cycle over the last 3-4 years. There could be price correction and time consolidation that can happen in the real estate. At this given point in time, except for a few micro markets, broadly demand and supply are matched, not too much of. And particularly if you are looking at the mid-income segment, demand is an issue. Demand is very strong in the high-end segment, the luxury project, not in the mid-income and the low-income segment. Those are the areas to be slightly wary of.
Yeah, that's interesting, Manish. So it reinforces that investing is less about chasing different themes or single geography or asset class, and it's more about thoughtful diversification.
Correct.
MK has a long track record across market cycles. So how's your investment philosophy, portfolio construction, and overall positioning for the current market environment?
So I think over the last 25-30 years that I have managed public money, there is a single style of investing, is to figure out how much money a company is going to make over long periods of, because a stock price is nothing but the present value of future cash flow. So your job as a fund manager is to figure out cash flow. And for cash flows, net profit is the proxy, because net profit plus depreciation is equal to cash flow minus capex is equal to free cash flow.
Correct.
And stock price is the present value of future cash flows. Through understanding the net profit growth, you have to figure out what are the nuts and bolts of how companies are making money and for how long they will make that money. So philosophy is very simple. Shareholder returns are only created when your returns from business exceeds cost of capital. So ROC should be more than cost of capital. Businesses should not be very cyclical. They should be structural in the context of India. Growth style of investing is the best way to play India, because India is a growth economy. Your real income, real GDP growth is 6 to 7%. Add a bit of inflation, your nominal GDP growth 9 to 10%. You buy growth in India in the context of India's overall growth. So growth stock, growth investing, look to buy companies which can double their profits in 3 to 4 years. And their businesses should not get disrupted very easily, because the whole world is full of disruption.
Oh yes.
They should have a long terminal value backed by good management and don't overpay. This is the simple mantra that you have to follow. Keep eyes and ears open at all points in time. You will have umpteen number of opportunities come to you. There is no dearth of ideas in India. You should have the temperament and the ability to analyze and figure out where there is money lying on the table.
Absolutely, Manish. I think this highlights the importance of consistency in the philosophy, and especially during challenging market phases.
And as far as your question regarding portfolio construction,
yes,
I like to keep it very simple. If you are convinced about an idea, buy 5%. If you are very convinced about an idea, buy 10%. And you maintain a concentrated portfolio, so don't require more than 25-30 stocks in your portfolio. That's good enough for diversification. If you want to dilute returns but not dilute risk, you buy more stock. But 25 to 30 is enough diversification without dilution of return. And keep it simple, no mathematical jargons. Very convinced about an idea, buy 10%. Not so convinced about an idea, by 5%, and that 5% also you can allocate in two tranches. Begin with a 3%, go up to 5%, and then see how the market shapes up the returns on that particular stock which you buy. That's the only methodology that we feel. And I think in terms of sectors, not more than 35% in a sector and not more than 10% in a particular stock.
Interesting, Manish. So high conviction, long-term approach.
Absolutely. And 3 years and above. Your viewpoint, 3 years and above.
3 years and above.
Long term is 3 years and above. Medium term is 1 to 3 years, and short term is less than 1 year. Our portfolios are designed for investors who believe in long term, which is 3 years and above.
Interesting, Manish. Talking about PMS and AIFs, which are your core offerings. So these are typically suited for investors with high risk appetite and longer investment horizons. So how should investors think about using PMS and AIFs as part of their overall wealth strategy relative to traditional vehicles like mutual funds?
Yeah, so it's a mutual fund plus something, right? So mutual fund will give you a basic, overall mass product. This is a specialized product suited only for HNIs and UH. They require something more. So maybe an unlisted option within an AIF. That cannot happen with a mutual fund.
With a mutual fund.
That is possible in an AIF. And today, when you talk about unlisted securities, you talk about different asset classes, this is only possible in AIFs, right? Cat 2 AIFs. These are venture capital, etc. They are Cat 1 AIF. These are only possible in alternates. You want a specific real estate vehicle, that is only possible in AIF. So, in a PMS, when you want greater disclosure and transparency, along with the returns, then you choose a portfolio management service where you are wanting something unique for your portfolio. So that is basically, I want to see my portfolio at all points in time. I want to see what my manager is doing, what he's buying or what he's selling, what he said he would do and what he's doing. I want to check. He said he's a long-term investor, but if he churns 100% in 1 year, then basically he's not a long-term investor. So greater transparency is there in PMS. AIF supports many other investing platforms apart from just equities, but apart from a taxation benefit is there in mutual funds, which is not available in PMS because you pay tax only if you sell the units of the mutual fund.
Correct.
Here you have to compute tax on an ongoing basis.
Trade.
AIFs, the tax is paid by the fund itself,
level.
the Cat 3 AIF. So apart from this, a fund is as good as the fund manager. It really doesn't matter too much, whether it's a mutual fund, AIF or PMS. Fund manager decides which product offers the better returns to the investor.
Thank you, Manish. Thank you. So suitability, patience and alignment with your overall goals. I think that is critical when considering such strategies. So I have a question on GIFT City, Manish, the inbound and the outbound funds. So that's emerging as a platform for Indian investors to access global markets and even for global capital to flow into India. So what's the real value proposition of GIFT City, and do India-focused inbound funds offer some real meaningful advantage to NRIs and foreign nationals?
Not really. If you're taking in global capital and deploying it in India, basically your dollar returns will be your rupee depreciation minus your Indian rupee returns minus your INR depreciation. That is basically your dollar returns, right? Your reporting currency. But only thing is there is ease of operation. Ease of operation, if you operate out of GIFT City or Mauritius or wherever, is there. But otherwise, it's very much different. It's only applicable if it's an outbound investment. You want to invest China, then you basically invest through a GIFT City dedicated outbound project. That is a nuanced option for people. Otherwise, I think it's the same, minus currency depreciation, nothing much.
So it's basically, more strategic rather than just viewing it as a...
See, it is ease of operation, ease of doing business. If you want to take India as an investment option, I will ease the way of you, a global investor wanting to come to India. So the GIFT City, you have no hassles whatsoever. You're not subject to scrutiny or regulators, so on and so forth. Basically, the return is your Indian rupee return because you're investing in India, minus your returns, the rupee depreciation or appreciation that you remove or add from the rupee. That's all.
So I have a question which most of the NRIs ask us. So they remain concerned about rupee depreciation, and as a result, they hesitate to increase their allocations to Indian assets. So how should NRIs think about the currency risk when evaluating investments?
3 to 4%. As long as you have a dependence on external flows, the FDI and the FII component to fund your current account deficit, Indian currency will be vulnerable. So the rate of depreciation of Indian currency should normalize be 3 to 4% every year. So you should look at the rupee returns, whatever rupee returns are there, let's say 12%. You should deduct 3% or 4% from that 12% to arrive at my expected rate of return will be 8 to 9. And basically this is what the dollar returns have been over the last 10 years or something.
So that still makes India stand out?
Not really. If you look at US markets, etc., they have given some exceptional returns. But it's very tech-heavy segment.
Yes.
India is very balanced. We are not so innovative angle. We have the bread and butter, consumption, savings, investment. But our pecking order in terms of returns for a global investor has not been that great. That is why you have seen a lot of FI selling, because on one hand you don't have very high rupee returns, on the other hand you have very high rupee depreciation. Why should the investors come to India? Unless you are looking at next 20 years. On a short-term basis, people have got disappointed because of the rupee depreciation. It has exaggerated in the last 1-2 years, but otherwise 3 to 4% is what you should build in.
So that's more like a long-term average.
Yeah, 3 to 4%. Yeah.
So I have a question on unlisted and private. You did touch upon in our previous question, but there's a growing interest in unlisted and private equity investments such as pre-IPO and private equity. Should these form part of the investors' portfolio, and what risks and suitability factors should they consider?
Yeah, the opportunity is very big in the unlisted space, and let me tell you something, that the real value of a company gets created while the company is unlisted. Bulk of the value gets unlocked when an unlisted becomes listed. So when you as an investor are buying, you are creating a lot of value by buying it very cheap. So you'll see a difference in valuation when the company is unlisted and when the company becomes listed. That's just the opportunity set. And I think there are many new nuanced businesses as India progresses from $4 trillion economy to $8 trillion economy. The pipeline of companies wanting to come with pre-IPOs, etc. is just humongous. So it is a part of the entire process where the entire corporate landscape is becoming organized. And I think the sky is the limit as far as the money-making opportunity in the unlisted space is concerned. But you have to pick and choose.
Pick and choose, yes.
You can't paint everything with the same brush, and this is applicable even in the listed space. So you have to be very discerning when you do your stock picking, when in the unlisted space, and you must understand what you are buying. So fund managers' capabilities, his track record of whether he has dealt with the unlisted space in the past or not will make a difference. His track record of dealing with illiquidity, because when you buy pre-IPOs and the stock doesn't get listed.
Oh, yes.
So liquidity risk is the major risk that investors should keep in mind when dealing with unlisted, apart from the track record and the performance. And at the end, the last but not the least is basically your the performance of fundamentals of that unlisted company, whether it has grown, it is growing, not growing, falling in terms of fundamentals. That will decide how the returns are shaped up. So when a company goes from unlisted to listed, there are many examples where you have big winners, but there are also examples where you have lost 50-70%. So risk and return come together. You have to pick and choose.
Absolutely. And as a fund, you mentioned that you do hold unlisted.
One of the funds. Yes.
One of the funds.
We have a AIF where you have investments both in listed and unlisted. That's a sweetener. I think we believe that when an unlisted becomes listed, there is not only continuing growth, but there is expansion in valuations also, which that gives you additional delta in terms of alpha.
So for investors who want to take exposure to the unlisted markets, so your fund could be a good option.
Yes, it is a good option
to take exposure. That's an important reminder. I mean, the liquidity, governance, and
those are due diligences. No compromise on all these things.
Matter more in private
100%.
markets. Talking about the behavioral factors, I mean, during volatile phases, behavior often becomes the biggest challenge. The investors, what are the common mistakes investors make? I mean, what you have observed, in your career, and how can they avoid them?
Yeah, so it's the same. Human beings just don't learn anything. The pendulum shifts from fear to greed and greed to fear, and excesses are created on both sides. When one understands that reversion to the mean is also the ultimate truth, but non-control over one's own emotions of greed and fear are the main reasons why people make a lot of mistakes. Every time a market goes up, it is a FOMO, which is the main reason why people get sucked in at very high valuation. Your neighbor is making money, I am not making money. Let's also get into the rat race before the bus leaves us. So that is one aspect. And then the other side is the world is going to come to an end.
Yes.
From greed to fear, fear to greed. It is a continuous momentum. And let me tell you, neither the world comes to an end at any given point in time. Neither is the world going to an abyss. If you miss the bus, there is no tomorrow. It never happens like that. There is no shortage of the number of कि बोलते हैं शेयर ही नहीं मिलेगा. भाई शेयर सब मिलता है, हर भाव में आपको शेयर मिलेगा. तो ये तो this whole narration about ले लो नहीं तो शेयर नहीं मिलेगा, this is basically so full of fallacy. That FOMO aspect. So tips, news based information, what this guy is buying, some big guy operator is buying or selling, just leave out all of that. Ultimately it is तोल मोल के बोल. जो कंपनी का जितना वैल्यू है उतना ही पैसा आपका बनेगा. जो है कुछ कर लीजिए, you have somebody big buying or not buying or mutual fund buying, FI selling, just doesn't make too much of a difference. Don't follow what others are doing.
Yes.
And that has to do with controlling your emotion. It is not so much about your capability to do research. It is more about holding your temperament, which determines how much money you make or how much money you lose.
Absolutely.
And markets will always test your patience, both on the upside as well as on the downside. And this is where you have to control yourself.
Absolutely. So is it true, Manish, average returns for a abnormal period of time
reverts back to mean. Mota, your index Nifty 50 will double in 5.5 years. So you should expect that anything more than that for extended periods of time, if they come, there will be reversion to mean. India is not going to cloud 9 just yet.
So set your expectations.
Absolutely.
Right. So discipline and long-term approach are as important as, the market knowledge.
Yes.
Talking about SIPs and systematic investments, so how should systematic investment be viewed during these market corrections, volatile phases, and especially
Don't discontinue. I think SIPs are the best way to stagger your investments. If you really cater to your financial goals in the long term, just keep on deploying. Identify your fund manager or your mutual fund scheme or PMS, AIF schemes where you want to just regularly top up. And logically, averaging down averaging up in an SIP way is the best way to go about it. There's a mathematics behind it and it has been proven time and again. Don't have to worry.
Probably that's why it's called the textbook method.
Absolutely. The thumb rule method of compounding.
Absolutely. So systematic investment is not just a volatility management tool, but it's a very effective way for investors to create wealth through compounding, provided they stay disciplined across cycles. So Manish, let's close with the favorite part, a quick rapid round. So just in a word or a phrase, you can let me know what you want to bet on or what's your preference. So let's start. Indian equities or US equities?
Indian equities.
Foreign inflows or domestic inflows?
Both.
Passive or active?
Active.
Large caps or small and mid caps?
Small and mid cap.
Lump sum or systematic investing?
Systematic investing.
Thank you, Manish. That was quick.
Thank you.
So before we wrap, if you had to leave investors with one key message in the current market environment, what would that be?
It's not the end of the world. Today we are living in an environment where there's maximum pessimism, and this again will give way to euphoria in a few years' time. As I said that life doesn't come to an end. So use these periods to maintain your discipline, to maintain your faith towards equities, because ultimately growth and valuations and earnings are the ultimate truth. Second message is don't try to become rich too quickly. For an ordinary investing, the main issue is that people want to become very rich through equities. That's the misconceived notion that if I don't make 20%, only 20%. Why 20%? Which other asset class is giving you 20%? People have got used to 35-40% returns. That is greed. Temper your expectations, but keep your faith is the basic message.
Absolutely. Bang on machine. Bang on. Thank you, Manish. That was an extremely insightful conversation. Your views on markets, asset allocation, global diversification, alternates and long-term discipline. They offer a timely reminder for investors navigating uncertain times. On behalf of Barakah Finserve, thank you for sharing your experience and perspective with our listeners.
Pleasure. Thank you.
Thank you
for having me here.
Thank you, Manish. A quick disclaimer before we close. The views expressed are for general information only and should not be considered as a personal investment advice. Investments are subject to market risks. Please read carefully the offer documents before investing. Thank you.
Thank you.